Stock market valuations. So how important are stock market valuations? As I said, again, off the top of the show, a lot of analysts, a lot of what we call market experts, investors, they believe that the stock market was a little bit stretched with respect to valuations. When we look at PE multiples, they were a little bit stretched, getting in that 18 to 20 range for a number versus 16 to 18, which tends to be a little bit on the slightly inexpensive or cheaper, or maybe even fair value versus, in that 18 to 20, 21 range, which tends to mean a bit overvalued, definitely fully valued. And so, what does stock valuations mean? And what actually does it not tell us? And because it doesn't tell us the whole story, right? It's just a snapshot in time. You take a look at a stock, you can tell me, PE ratio is 10 times or 11 times or whatever it is, or 20 times, but it doesn't tell us the whole story. It doesn't tell us what the growth is. It tells us what the earnings are, but what's the growth rate? The PE ratio doesn't tell us that. And that's why many investors use the PEG ratio instead, price to earnings to growth, because we want to know if a stock has a PE of 20, but its growth rate, let's say it's growing earnings or growing top line at 30%, then maybe that's a stock you want to own, even though PE is a little bit high. But if it's growing at a 30% clip, then a 20 PE is cheap. So it doesn't tell us that. It also doesn't tell us what's going on within the company itself. It doesn't tell us what management is doing, what the CEOs are saying. It doesn't tell us what's going on in the future. Although, yes, we do have, future PE, forward PEs that we tend to use. I tend to use forward PEs quite a bit. But again, it's an estimate, right? You're using a forward earnings multiple or an earnings number. You're then taking the price and you're calculating it based on what you believe NVIDIA, Apple, or whatever stock will earn, whatever company will earn in the future. So you're taking forward earnings multiples, a forward PE. So stock valuations is something that doesn't tell the whole story, but it is a very important story. And that's what we all track. And of course, if investors track it, and if it is important for all of us, stock multiples, then it's definitely important for all of you viewers, and it's obviously going to dictate how the stock market reacts. So here we have again a couple of charts. First one talking about PE ratios as a whole for the S&P 500, and you can see a huge spike in PE multiples in 2021, and that's also coincidentally when we hit our all-time highs on the S&P. You can see how fast they came down in 2022. And here we are again starting to rise. And that shaded area is, as I said, it's kind of the area that you're going to be in that fair market value area. When you start to get to the top of that range, you're kind of getting a little bit more expensive and a little bit overvalued. So a lot of people believe that PEs are telling us the stock market is a little expensive right now. The next couple of charts that I have here, we can show again tells us a bit of the PE or stock valuation story. The Dow Jones Industrial Average a year ago, 21.73, today 26. Again, a little bit higher. Transportation average, a little bit higher. Interesting enough, the utility stocks, the utility part, the Dow Jones Utility Average, lower than it was. And we know why that is, because we just came through a high interest rate environment. Utilities are interest rate sensitive. So we've seen utilities fall in value. You've seen names like Emera, Fortis, other utilities in the US come down from their high points that they reached a few years ago. So actually, utilities are a little cheaper than they were 1 year ago. Here you have some other indices just below. Russell 2000, actually a lot cheaper than it was 1 year ago, less than half. Then you look at the NASDAQ, a lot more expensive, trading at almost over 29 times. And lastly, the S&P 500, 21 times. Year ago, it was around just over 18, which is probably in that fair market value camp. So we're definitely seeing that valuations are a little bit higher. So people will ask me, Alan, should we still be buying stocks if things are a little bit stretched? And the answer to that question is yes, because we know that even though the index, whether it's the S&P 500, the Dow, the TSX, the NASDAQ, whatever index you're looking at, it may be they're telling us that the valuation on the overall index is high, but you have to look at each individual name within the index. And I can tell you that a lot of these indices valuations are high because of tech stocks. Tech stocks, which make up the majority of S&P 500, almost 30%, as we've discussed in the past. They're the stocks that have taken up the valuations, and behind it have been many good quality stocks that are actually still trading cheaply. So this is where you have to do your homework. This is where you need to consult an investment advisor, consult your investment advisor. Give me a call if you don't have an investment advisor or if you want a second opinion, because I will tell you there are a lot of good quality names to be buying now, even though the indices are showing or telling us valuations are a little bit stretched. The underlying stocks that make up these indices, I don't think they are as high value as the overall index is. And I still believe there are a lot of opportunities to make buys at the start of this year and throughout the rest of 2024.